Good morning and welcome to Equity Story, the 5th of April, Wednesday, and I'm here with Claude. So middle of the week, we're going to talk some fundamentals today. And for our thought of the week, I thought, because I've been reading lots about single stock portfolios recently, I thought, okay, well, let's play this little game. And if we're going to have one stock for the long term, what would you sort of hold? What would you buy? And have it as a single stock, as a portfolio. So I'm fascinated to see what you say. And I know what you're going to say, but I'm fascinated to see how you're going to talk it through. Mine is fairly obvious, but anyway, I'll talk through it too. Before we do that, Equity Story disclaimer in front of you. Of course, general advice only. Every story we talk about is based on technicals and fundamentals only. All right, so welcome, Claude. And I want to first of all start off with just talking about last night's action in the US. And for me, it looked like a little bit of profit taking after a pretty strong run. So I'm not too worried about it. Fairly healthy to see that. However, our market's actually not too bad this morning either. So obviously from that point of view, I'm all good. What I found actually quite interesting and fascinating, first of all, gold went over $2,000 yesterday. So possibly you've got that gold plays where you've been looking at some of these NSTs, EVNs, and so on to keep going with them, because now it looks like maybe we're going to go gallop through it. So that's good. But the other thing that caught my eye, Claude, and you can see probably the screen right here. I've been looking for inflation, and in some places in the world, it's actually not that bad at all. You look at things like Switzerland, 2.9 from 3.4. You look at Japan, 3.3 from 4.3. So they are dropping, right? And some of these inflations, it's you look at US, Australia, and UK, you think, oh my God, inflation is just going to kill us. But look at Spain, 3.3. Netherlands, 3.4. The Eurozone is actually 6.9. It's come back from 8.5. So we're on the way down. It's actually not that bad. There's a lot of, possibly still a lot of fright in the inflation stuff where we're going to keep going with this interest rate, but maybe we're not that far away now. But just looking at this, and I know there's obviously some outliers here with Turkey 50% and Argentina at crazy 102%, and some of the other lesser knowns, of course, struggling. But generally speaking, those numbers don't look that crazy for me to be really scared. But it's still high. We need to get it down. But it's just interesting to just have a look at what the actual numbers are compared to some other countries. Like, US 6%, France 5.6. It's at the moment it is manageable, but they obviously need to bring it down. All right.
And what do you think about Australia though with the interest rates? Do you reckon now interest rates has actually peaked and it's going to stay flat for a while, or do you think they'll resume their hiking at some point?
Look, I think they're going to hold for a little while. Just on the back, what I've seen from inflation in Australia, some of the numbers are trending downwards, right? So that's a good thing. I know that in the speech post the RBA raising rates yesterday, they really leave themselves a door to say we can raise if we want to, right? If the numbers suggest so, we do so. But I think maybe we're at the peak, and it would be surprising actually, because I know that we need to bring them down, but maybe over the next couple of months, the numbers will come down by themselves because we've already done enough damage. And, seeing the collapse, for example, of the builder, that's going to throw a lot of people out. There's people losing their jobs. It's actually in the background, things are going sour for me. So I think that's a pointer for me that maybe they've done enough damage already with these interest rates. And it will probably show up in the numbers over the next 2 or 3 months. That's how I feel it's gonna happen.
And you are seeing some companies with debt now. Their profits are being hampered by high interest rates too.
Exactly, and you've seen people sacking a lot of to cut costs, right? So it's been happening. So we know that probably the unemployment will rise. And again, numbers from the US yesterday, they said that they had the lowest employment ads for about 10 years or 20 years even. Something crazy like that. I'm thinking, really? So okay, so obviously there's not many positions open in the US, which is a precursor to possibly the US economy going south. and maybe inflation following south as well with that.
But
Right.
just to play devil's advocate on one last thing,
Yeah,
though, we did see petrol, well, oil prices and gas prices go up a bit lately. Obviously with the OPEC caps. I would, that on the other hand, you would have to say that would be pro-inflationary.
100%. And, that's always a left field type thing because OPEC, has got its own way of operating. And that, of course, could potentially impact. I have been reading some articles about that from a couple of, industry experts and economists. They don't see it as a big threat because they reckon that still $80, that's what they priced into the whole global economies of dropping inflation anyway. So at 60 something bucks, they thought that actually the oil price went way below what they expected in their own numbers on their own figures. So, for them, that's just regulated back to that $80, for example. So they weren't too worried. But, anything above that goes back to $100, then maybe we start worrying again. But yeah, absolutely. That could be maybe an issue down the track if the oil sort of starts surging up. But I saw yesterday it was okay. So I'm just going to quickly go to commodities to show you what's going on there. And like I said, gold, which is here, is 2022. That's obviously very positive for gold. You can see, let me see, Brent's and crude at about 81, 85. So that's what I mean. Anything about 80, probably it's starting to look a little bit more dangerous, but it's still okay-ish. And other than that, it's been fairly flat to negative yesterday. And I think we've had Rio BHP go backwards last night. So that's probably going to weigh on our market. All right. Company news-wise. So I'm going to quickly jump into the screen that show you some charts. And we'll see probably some gold because there's been some quarterly numbers coming through. So let's start with Gore. Had an update this morning. And look, I don't mind this company. It's got a big deposit. It's also got a big partner. They've got they've just updated. They're going to keep growing. I suppose not keep growing, but keep exploring for possible upside to the other project they've got under the wings. And then also, obviously, we should mark as they've got production keep going until another 10 years, I think 2032 or something on those lines. So all in all, very decent, definitely tradable, looks all right, but maybe there's a bit of resistance around 81, 85. Next one, Red came up with their updates, talking about production and costs. So let's have a look at the chart on this one. So this one's below trend, and the reason why, the actual costs are still fairly high. And it still needs to probably find a little bit of consistency in the numbers, production and costs. So one that definitely not to be touched at the moment. Let's look at Alkane. Their costs were much lower than Red's. So definitely better from that point of view. But let me just put that on, show you the chart. And I'd say that's probably reflective as well on the chart. Yep, it's actually not bad at all. If it stays like this end of the week, it's still probably a buy for next week. Especially with gold now over 2022. CMM is another one that came up with some numbers today. There's been a market darling for a little while. It's okay. It's had a little bit of a run. Can it go on with this 2022 gold price at the moment? There's again a little bit of resistance around 5. So maybe not the best looking charts. Let's look at WAF, another one that came up with an update in Africa for their project. And again, one that's trending below trend. I still like it, but it just needs to come back over the trend line. So do not touch that one. Let's have a quick look at WA1, less gold, but this one's more niobium and rare earth. So let's have a look at this one. Just possibly one for the traders out there, because they did say that they are rushing these assays through to lab in Perth because they come up with more of the similar type mineralization, carbonatite, which hosted the previous pretty good results, right? So from that point of view, if you're a trader, you'd be watching these results with, I suppose, great interest. So if there's any movement in the share price, I'll probably be jumping in and maybe just trying to have a little trade here. So it's looking good. And if it stays like this could be a buy signal by the end of the week. So definitely one to watch, WA1. All right. last one is in that mining space, DVP. So I really like that one from the point of view that Bill Beeman is in it. He wants to obviously make this as a conglomerate of some kind in the mining services, in the mining industry as well. And I know someone yesterday asked about zinc when we had that chat yesterday, Claude. In fact, these guys have got a big deposit called Woodlawn in New South Wales, which is an old zinc mine, zinc copper mine that produced for about 20 years. And they wanted actually they bought it out of administration. That wanted to restart it. So possibly if you're looking for zinc, that could be one that want to follow maybe over the next 6 to 12 months if zinc obviously behaves itself. Anyway, a couple of more things. So one more thing from me is VEA, and I'm not sure if you had a chance to have a look at that acquisition, Claude, but VEA, I'm surprised that I've never heard of this OTR right until today, but that chart looks fabulous. What do you think? Have you had a chance to have a look at it?
I had a quick look at it. Look, I agree that it doesn't seem obviously cheap, given that it's supposedly on 7 times EBITDA, but that's post synergies, pro forma post synergies. So, yeah, probably not like obviously cheap. But having said that, it should be positive for EPS. They're basically saying, it's EPS accretive. Although that is partly because it's taking on a lot of debt to do that. So overall, it seems like it's kind of a risky acquisition to me that they might end up regretting if there's like immediately a slowdown. So that might not be the best timing, but overall, I guess it'll add scale to their sort of retail and convenience network. So there might be like a sort of distribution advantage there. So I wouldn't say it's terrible. And also, I guess in the short term, if you were in this, I wouldn't see it as a reason necessarily to get out. Obviously, the market likes it. It's expected to put like the earnings per share up. There's already quite a low PE ratio. And obviously, it's not without risk either, because it already has a lot of debt as well. So it's just sort of a high. It could be a value trap long term. This isn't one that I would think of as a long term hold, but also today's news, it's probably just good for the momentum of the stock. Probably puts it on a few more radars, and I wouldn't see it as I still think it would be a hold basically, and that this is probably gives you reason to hold, as one would hope. It will then filter through down to a few upgrades from analyst forecasts, increasing their price targets, that kind of thing. Could be good for the share price. So I'd say if you're in it, definitely hold on. If you could even buy it for a trade, although whether you're in it or trading it, just remember, I think that, it's taking a lot of risk. There's a bit of a cyclicality to the business in the refining side of it as well. So definitely it could go down quite hard when the music stops, but for now things are going well, so I just enjoy the ride.
Yeah, look, I agree with everything you say here. I suppose the rationalization for me why they're buying it, they just wanted to diversify themselves away just from the refining business, wanted to get more I suppose revenues and a bottom line out of the convenience stores, which they obviously this is what this is going to be all about. Well, good luck to them. Look, I don't mind this, but like I said, I'm probably agree with you here. More of a trading, more maybe of a dividend type play here, and it could be cyclical with oil gas going backwards again. So holding right now, no problems whatsoever. It's gone through the technicals beautifully of the buy signal last week. So again, well done today with the charting on there. It's done very, very well. Good luck to anyone who's holding it, because it also pays a great dividend as well. So it's all pretty good all around. All right, let's move on to the next bit, and that is the thought of the week. So I sent you a little memo saying, all right, we're going to have a look at a one stock portfolio because everyone's doing it. So we're like, okay, well, let's have a look at it. See, let's have a bit of a game. And if you don't mind, I'll go first. And I've chosen, surprise, surprise, Wesfarmers. I know it's fairly safe, but there's a reason why I'm so strong on Wesfarmers. And look, let's first of all look at the technicals, because I want to just demonstrate to you why I think this been a great performer over a long period of time. So of course, maybe, those years here when they had the coals and they were struggling because they just could not come up with good returns for coals, that was actually weighing on the business. Once they got off coals, it's all of a sudden it's changed. It's just started to look so much better post the coals disposal. And then it started going up and up and up. So before coals, it was a good return on equity business. During the coals years, it was a very low return on equity business. Once they got rid of that, it's started going again. So it's a business for me that obviously invests into other businesses. And it sometimes makes mistakes. I know that they made a big mistake going into UK with trying to set up Bunnings out there. And I think Coles wasn't a fantastic move, but they've also made a lot of good business decisions, Wesfarmers. And that's what I like about it. And, no one's going to be perfect here. So for me, you're getting a business that is pretty shrewd, good operator. So I think they usually follow the trends out there. That's why they got into lithium recently. That's why they got into pets recently. That's why they bought Priceline recently as well, from Sol. So you can see the rationale behind their thinking here. They're following their longer term trends. And if something's not working or thinking it's going to change, they got rid of it, just like they did with the coal, right? They sold the coal division to another player. Maybe they've gone a little bit early, but they could see the writing on the wall where they want to move into renewables on something on those lines. So I like the fact that they're obviously thinking long-term and thinking about the future as well. So that's the beauty about it. Now, the other thing is, if you look at the actual company itself on the financials, it's actually not too expensive when you look at the historicals, right? 23 times is not too bad. 5% yield. So you've got a business. If you've got a one stock portfolio, you've got growth in there. You've got, it's not too expensive, I suppose, if you look at the long term. And you've got a yield as well with this. So you've got a few things here hanging positively for you as a story that you can hold on. And if you put all these things together, and I'll actually show you what business they own, because this is also very fascinating. So just give me a sec and I'll show you. And that is, where is it? Hang on a second. I'll go there. Okay. Can you see it? The Wesfarmers businesses, they've got obviously Bunnings, which is, the key here for them. They've got Kmart and Target. Maybe that's been their sort of, one leg out, one are going okay. Then you've got the fertilizer business. They've got this lithium as well. When you start looking, thinking, my goodness me, they're actually quite diversified conglomerate. Officeworks. They've also got this health business unit with API. Salt Partners Chemists. You've got this obviously Priceline. They've got a digital division as well with Catch. Maybe that's also been dragging at the moment. God knows what they're going to do with that. They've also got 5. It's just got fascinating businesses on this book. And I can imagine they're going to keep going and going down the same path with disposals, acquisitions, and all this sort of things. So for me, a long-term one stock portfolio makes a lot of sense. So I'm thinking I'll even just put in your other stocks with the portfolio, it's probably going to be pretty good as well. But I think for me, it's probably up in the top 3. So if I'm going to choose something, this would be it. And look, I probably had about 2 or 3 different candidates, but I'm going to stick with Wesfarmers. All right. Over to you.
Well, I took it in a slightly different spirit. I agree that Wesfarmers as a conglomerate with various interests would be an excellent choice for a real life single stock portfolio. But when you said it to me, you're like, oh, well, if you had to only have one stock, what would it be? And I guess what I would do is definitely different from what I would recommend other people do.
Yeah.
That's okay. I kind of built. So if I had to choose a stock for to be a one stock portfolio seriously for someone else to do, I'd definitely choose something like Wesfarmers or Washington H. Soul Pattinson, or if I had to do something that was a little bit less, if it was going to be less diverse, I'd choose something like CSL that has a really strong moat.
Mm-hmm.
And CSL right now, actually, I'm interested in what you think of that chart. But if someone was like, you have to sell all your stocks except one, the one that I would keep would be Energy One. I know the chart's not great, and that's because the profit result wasn't great. And the reason the profit result wasn't great is because they're reinvesting in basically new products and services that should set them up to grow, for many years to come. And over the course of their listed history, over the long term, they've definitely, I've seen them, invest in products, eventually sell those products, get those profits to come from those products. And I believe they can execute on their plans. And, as it stands right now in terms of valuation, it's a software company on about 25 times earnings, trailing 12-month earnings. It has very sticky revenue. It has a bit of debt, so that's probably like some risk there, but it has fairly, I don't think, it raised capital at $4.50 without much trouble not so long ago. And it sort of, I think it's going to be fine through hard times, and the next couple of years of investment are probably setting it up for strong growth in years to come. So because of that, even now their profit is just like depressed by the fact that that they are investing in growing their 24/7 operation, and they need like all these cybersecurity consultants and certifications and all this sort of stuff in order to start trying to win those big contracts with bigger operators. They announced just the other day that they'd done a deal with Shell for operating some of their big battery kind of stuff, and I hope to see more in the years to come, and that'll have to be just the start. But either way, as some of this expansion expenses rolls off, and their contract wins can be like a little bit lumpy. They don't always come through every year, but assuming they do keep coming through, I think that it's going to look very reasonable at these prices in a few years. But of course, the short-term outlook is they're spending on growth, and so that means that probably there's no positive momentum in the share price at the moment. But this is one that I'm going to hold on to because I only need to run like really big winner every 5 years or something like that. And I think that this is a company that could be a lot bigger in 10 years. It's only, as I said, its market cap is well under 200 million. It's currently only 115 million. It could easily be a $500 million company one day.
No, I like your thesis. I actually don't mind this company at all. And it's just having last 12 months hasn't been brilliant. But if you look at the previous charts, technically speaking, Claude, it is definitely on the up. So
I think maybe now's probably not the right time. It might be like if you're like want to have easier experience of it, you could wait until the results start showing some improvement. But I still am going to hold this one, I think. Yeah,
fair enough. And look, like I said, I can see it if they can improve their performance, or at least update positively. You can see that's recovering and getting back to that growth phase again like they had previously. So charting wise, I've got no problems. It's obviously just the last maybe 6 to 12 months. Then you think to yourself, it's not trending, it's below trend. You might be playing with it, but it will come a moment for it to have a look at it again. And I like the fact that you've chosen something left field that no one's actually thought through before. Because we all go boring. There's the Macquaries of the world, there's the Wesfarmers of the world. You went with EOL, which I would have thought if I was going to choose, I was thinking there's something. He's probably going to choose PME or something. So it's like,
well, that also like basically PME and Energy One are my biggest two positions. They're similar size in my portfolio. I also would never want to sell PME basically, but I have like sold some now because, well, basically it's trading on 125 times earnings, and these guys are trading on 25 times earnings. Now PME is a better company, but I think part of the reason this company is on 25 times earnings is just because they're reinvesting in the long term. And when a company is smaller, any kind of hit to profits, any kind of reinvestment can really impact its profits. Mm-hmm. But once it gets bigger to a certain degree, then hopefully little fluctuations in how much it has to invest doesn't have such an impact. And that might only be a portion of the growth that year, so it still looks like it's growing. But at an underlying level, like this is becoming a bigger company, it's getting more revenue. It says it has sticky customers. Its track record of having very sticky customers, that's a good starting point, because it means the customer lifetime value is really long.
Yeah, no, fair enough. And it's, like I said, your thesis obviously is pretty strong here. So I've got no issues with that. And look, I reckon in 3 years' time you could really probably maybe killed the pig. And I'm thinking, why did I choose Wesfarmers? I could have gone EOL. You just never know. So I like the choice. So
I think if anything, it's like it's a longer term thing. Like I'm assuming that the same management team are in this company in 5 years, 10 years. I have a feeling that they'll be like, a lot more popular than they are today.
All right. So thank you very much for that, Claude, for joining me today, giving me your obviously thoughts on our one stock portfolio. What will you put in there?
But yeah, my more sensible one for other people would be CSL is a good one.
I don't mind if look, I think I think EOL is sensible, but of course it's not going to be for everyone, right? So
I don't think it's sensible to put in a one stock portfolio in EOL because it's like, I don't think anyone should
maybe
do that.
not right now, but if it starts trending, maybe it does make sense, right? So I get it. I get it though. This is the beauty about it, is because you are backing your choice with a nice strong thesis why. Which, for me, it's always very important. I don't care what you tell me, as long as you can back it up, right? And you are.
The other one that I think is a good real life one stock portfolio is probably Google. It's pretty strong. Like it'll go up and down with the global economy, but it's a rent seeker on like almost every commercial transaction. There's hardly a company on earth that doesn't pay money to them in some way.
Yeah, look, interesting choice. And if I was going to choose something in America, I'd probably choose Microsoft, MSFT. Which, and again, everyone is probably using one of their products somewhere along the line. So,
yeah, I bought both of those companies not so long ago, shares into both of them. So I like those.
Maybe we should have a little game. Get Dave as well. Choose one stock and see how we go over 3 years.
Yeah, that's not a bad idea.
All right. Thank you so much, Claude, for joining me today. Have a great day, and have a great day, everyone. And I'll see you again tomorrow with Dave.
See you, Peter, and thanks for watching, everybody.
Thank you.